Welcome back. You're still tuned into Trading Hour. Smartworks co-working spaces reported good Q1 numbers. Revenue surged 21%. Their P&L EBITDA expanded 55%. Their losses have also narrowed. Neetish Sarda, who is the managing director at Smartworks co-working spaces, is joining in now to take a few questions. Neetish, thank you so much for joining in. Well, losses have narrowed for you this quarter. So could FY26 be the year where you will see profits on the bottom line? Also asking this because majority of your revenues are coming in from the IT space. We saw those layoffs coming in by TCS. Do you think that is something which could impact demand? What is the tenure of agreements with bigger clients of yours?
Absolutely. First of all, Sonal, thank you so much for having us on your show. Smartworks has shown tremendous growth over the last year. We are well on track to become not just India's, but one of the largest flexible workspace in Asia with our presence in Singapore now. We are already India's largest with a total of footprint of over 12 million square foot and have consistently performed on improving all our financial metrics, whether it's our revenue, which has grown to 379 crores, which is a 21% jump year on year and almost a 6% sequential growth from the last quarter. Our cash EBIT or our normalized EBITDA, which is our NDS EBITDA minus all the lease liabilities that we pay, has significantly grown to almost 61 crores, which is a 100% jump from the same quarter last year. So Smartworks is moving towards increasing all its financial metrics on a non-GAAP basis, which is removing the NDS adjustments that we have. We have shown a profit of over 16 crores in this quarter because of the accounting provisions that we have to create because in the high growth stage that we are in. There is a loss, but if you look at that loss, that has also meaningfully come down from 23 crores. We stand at 4 crores in this quarter. Last year, that number stood at 60 crores. In the first quarter of this year, it's only at 4 crores. So our metrics are increasing with the significant increase in scale. So it's a very good situation that we are in. To answer the second part of your question on the growth of the industry and the demand for our product, while obviously IT/ITES is a significant portion of India's commercial RE, for Smartworks, that number is only 42%, which is lower than what the industry standard is. In commercial real estate, IT/ITES contribute to about 60%. So we have also onboarded a lot of manufacturing, BFSI, logistic companies into our platform who are expanding with Smartworks across the country. And with our strategy of focusing on mid to large enterprise clients, the tenures that we are able to get with them are much longer in nature. On an average, we get a tenure of over 49 months with these large enterprises. And our occupancies are very, very steady. In fact, our committed occupancies today stand as high as 89%. So you'll see these numbers continuously go up.
Got that. Neetish, hi, Rima here. Adjusted EBITDA came in at 16%. In FY25, I think the number was 12.5%.
Yes.
So what led to the margin expansion on an adjusted basis? And can you hold on to 16%? And plus, you will repay the debt, right, that you raised right now from the IPO proceeds. So will that not overall help in you turning profitable even with NDS accounting?
Absolutely. Thank you for that question, Rima. I think for us, if you look at our total numbers, it is driven significantly by the increase in our occupancy and the new centers which are driving towards the profitability. Despite that high growth, we've been able to demonstrate an increase in EBITDA margins from 12.5%, as you mentioned, to almost 16% this quarter. It is driven basically because of 2 or 3 things. Our SG&A cost, which is our corporate cost, keeps going down with the larger scale that corporate cost gets distributed over a larger base. And I think with our frugality, our operational cost and other costs are also going down. With the increase in occupancy. So all of this is contributing towards the EBITDA growth margin. If you look at our last quarter from the year, we had already grown. So 12.5% was the entire year. Quarter on quarter, that number is continuously increasing. And you'll see that trend from 9.5% in the first quarter last year. We ended the year at 12.5% on average, and we've started this year at 16%. So you'll see these numbers go up. From the use of funds, from the IPO money that we've raised, we've repaid 114 crores of high cost debt. That will help us reduce our finance costs significantly. The NDS EBIT profitability that you were talking about is also subjective to the new centers that we add. So if we end up adding a significant amount of centers in this year, the accounting provisions that you need to create is on the year that you add those centers. So it is very difficult to predict that. But on a non-GAAP basis, which is normalized for any NDS adjustments, you will definitely see a continuous growth. From a negative 3% last year, in the same quarter, it has grown to 168 million, which is 16.8 crores this quarter, which is a 4.4% PBT.
All right, Neetish, running out of time. I had more questions, but thank you for sparing time and joining us today. Wish you good luck for the rest of the year as well. Smartworks co-working spaces there on the show. Take a short break. More on the markets on the other side. Stay tuned.